All right, let's dive right into this explainer. We're looking at Starbucks today, the absolute giant of the coffee world. But right now, they're dealing with this really wild, counterintuitive business anomaly. We aren't just going to rattle off basic numbers today, okay? We're going to put on our investment banker hats and dig into the real narrative behind how modern businesses actually get valued. Because as you'll see, this is exactly where high-level qualitative strategy violently collides with hard, quantitative reality. So take a look at this jarring contradiction right at the heart of their business. On one side, you've got this incredibly aggressive global expansion story. I mean, they are literally opening 50 to 100 stores a year in emerging markets like India, just blistering growth. But at the exact same time, they're wrestling with what we can call a profitability paradox. They're trying to figure out their core third-place identity, that cozy premium hangout spot between home and work. So you've got this hyper-aggressive physical expansion just slamming headfirst into serious operational and brand identity hurdles. It is honestly a total scroll stopper of a business case. Now, despite those mixed signals on the ground, the current market data paints a totally fascinating, almost contradictory picture. If you look at standard discounted cash flow, or DCF models that the street is running right now, using projected Q2 2026 data, a lot of them say Starbucks is actually trading at a massive premium. We're talking 34 to 47% overvalued. So you really have to ask yourself, why on earth is the market giving them this high valuation when their day-to-day reality is so incredibly complex and full of profitability hurdles? Well, the crucial takeaway here is that this massive discrepancy doesn't just mean the mathematical model is wrong. Actually, it reveals that the market is pricing in a story. They're pricing in a narrative of an operational turnaround that the current cash flows just haven't realized yet. Investors aren't just looking at the cash those stores make today. They're buying into the future vision of what those hundreds of new Indian stores will become once Starbucks figures out its identity crisis. And honestly, this is where we cross over from basic, boring accounting into high-stakes strategic valuation. And that perfectly lines up with the hard truth of deal advisory. Look, it is so incredibly easy for some junior analyst running on zero sleep and like 3 iced coffees to build a flawlessly formatted Excel model with perfect little decimal points. But here's the secret. A discounted cash flow model is really just a highly sophisticated piece of financial fiction. It's an exercise in human judgment, perfectly disguised as an algebraic equation. You can have the absolute cleanest Excel architecture in the world, but if your human assumptions are even slightly off, your entire valuation just crumbles. Let's talk about the WACC illusion for a second, the weighted average cost of capital. The textbooks give us this neat little formula that makes it look perfectly scientific, right? But calculating it actually involves historical choices, debated equity risk premiums, and totally subjective size premiums. Get this. If you tweak that discount rate by just 50 basis points, literally just half of 1%, you can swing a company's enterprise value by millions. In one real-world test, that tiny 0.5% tweak dropped a target company's valuation by a staggering $45 million. The Excel math was flawless, but the valuation itself was incredibly fraudulent. Investment bankers know for a fact that textbook math just totally breaks down under real-world dynamics. Beyond the WACC illusion, you've got the terminal value trap. In most DCFs, the terminal value makes up over 70% of the total enterprise value. So, if an analyst plugs in a terminal growth rate of 4%, but the country's long-term GDP growth expectation is only 2.5%, the model is technically assuming this single coffee company will eventually grow so big it swallows the entire global economy. Excel won't flag that error, only human judgment will. Oh, and then there's management forecast bias. Execs are structurally incentivized to project hockey stick growth. If you blindly accept their optimistic projections, you aren't calculating intrinsic value, you are literally just calculating the price of management's optimism.
Okay, so how does this play into the multiple paradox? Well, looking at Starbucks in this current cycle, a novice might see a price-to-earnings ratio of 75x or higher and just immediately make a snap judgment. But an expert knows the PE ratio is totally a novice trap. It's heavily skewed by capital structure and non-operating stuff. It's a lagging indicator. It basically reflects past volatility and high expectations. The pros look to the forward-looking enterprise value to EBITDA ratio instead. That metric looks at debt plus equity against forecasted operating profits, which is way more indicative of Starbucks' aggressive international growth strategy.
So with all that said, how do we actually make sense of all these conflicting models and lagging indicators? We use what's called the football field approach. Instead of looking for one single magical point estimate, we visualize overlapping methodologies and valuation ranges. It provides a massive reality check. You line up your DCFs, your public comps, your precedent transactions, and when you put all those ranges on a chart that literally looks like a football field, you finally see how deals actually get done in boardrooms. Real valuation is never about finding one perfect number. It's about finding a realistic negotiation range and figuring out which assumptions you actually have to believe to make a deal make sense. To truly read between the lines of these valuation models, you really have to ask yourself a critical question about the future of a company like Starbucks. Moving forward, are you getting distracted by raw unit growth, or are you actually watching shifting consumer loyalty and operational efficiency? When you see 100 new stores opening in India, does that equal guaranteed future cash flow? Or does it just mean higher capital expenditures while the core brand identity struggles? Your spreadsheet cannot answer that for you. That takes deep strategic judgment. Ultimately, numbers are just the vocabulary of finance, but the real story, that is always written in human behavior and strategy. Keep that in mind the next time you're looking at a stock price.